Welcome to Fear and Greed Summer Investing Series, brought to you by Vanta, specialists in compliance-led growth. I'm Sean Aylmer. As part of this series, we've been hearing from analysts and investors about the stocks they're keeping an eye on in 2025. We've had a few surprises and plenty of household names. Today, Grady Wulff, market analyst at Bell Direct, is giving us her 3 stocks to watch. As always, this is general information only. You should seek independent advice before making investment decisions. You've given them to me, Grady, outside the show, so let's jump right into it.
Yeah.
JB Hi-Fi.
JB Hi-Fi is one that rose to the top this year, and I know a lot of investors think it's an expensive stock, but there's a lot of tailwinds and a lot to like about this company. Now, JB Hi-Fi is one that has really thrived through their downturn in their retail spend recently. They have their cost structure down packed. They target youth and they target the younger demographic. As we all know, the younger demographic does not have any cost of living fears or any cost of living pressures at all. They're living at home. Their parents pay for their food and rent, so what better way to spend your money than at JB Hi-Fi? Now, the company has expansion over Australia. They have it in New Zealand, and their first quarter update was very impressive. Analysts and brokers alike were really impressed with their update. They've got like-for-like sales in the single digits, which is what we're expecting across the board, so that's nothing to worry about. And especially in a time where retail spend is coming down, they are continuing to go from strength to strength. They also have acquired that 75% stake in ENS, so that expands their home goods sector, which is the good guys which they own, and then that expands their footprint there, so to better compete with the likes of Harvey Norman, Nick Scali, all of these companies. So they're really expanding their revenue opportunities and their expansion over all the homewares, not just tech in the Australian and New Zealand space. Now, at the moment, we like the fact that they have obviously sales growth momentum into the new year, but they also play into the AI theme with all of their computers that they're selling. So they're selling these really high-end computers. They're the number one for technology in Australia, and they're on our horizon next year for many reasons, not just for the AI space, but they do offer that exposure to the AI revolution through a different way, but through the retail space.
Okay, and there's always a risk with every investment. What are you worried about? Is it the interest rates and cost of living?
Yeah, interest rates, cost of living is what's concerning us on every investment horizon right now. We're seeing at the moment, obviously, the RBA is saying higher for longer, but it's literally a meeting by meeting case at the moment because as we've seen in the US, inflation has become sticky again. That's why the Fed in the last meeting of last year has gone and said, no, to 4 rate cuts is now 2 rate cuts in 2025, and investors were very displeased with this. So it's a meeting by meeting case right now, and obviously interest rate and inflation drives the economy and the markets right now.
Okay, number 2, James Hardie Industries.
Yeah, James Hardie's a really interesting one. They're the number one for fibre and cementing in the US at the moment and in Australia. So they have the real exposure in the US. 72% of their revenue comes from the North American operations. Now, as we know, Trump tariffs coming in is going to really hurt a lot of companies that have exposure to China and all different areas around the world and import into the US. But James Hardie actually operates in the US already. And so that can be a really positive thing for James Hardie Industries with the Trump tariffs coming in, because Trump obviously wants to stimulate domestic demand and domestic use of products. So with James Hardie having operations based in the US, that means they're going to bode really well there. And with the fiber cementing that they have for the housing in the US, each of the houses have about a 40-year life of this before needing to be re-cemented and refibered. And so we're getting to the point in the cycle now where James Hardie is going to be really needed, because a lot of the houses, I think it's about 80% of houses in the US, need their refibering at the moment. Wow. So that really drives demand and tailwinds for James Hardie Industries, which has a market-leading position in the US. They've also recently announced some price increases, which obviously we like to see because margin appreciation means more profits. And at the moment, we've got our price target is $64 per share over the next 12 months at Bell Potter, because we see that there's an implied return of 19.2% if the share price does get to that point, and we do see the tailwinds are there. And there's a lot of upside potential, and the company has good exposure both in Australia, US, and around the world.
Okay, just quickly, Coles, one that we all know.
Coles Group. Coles is, I think, creeping up on Woolies recently because Woolies has had all these troubles and obviously the duopoly in our Australian supermarket industry. Now, Coles has over 870 stores. They have the 50% stake in Flybuys, which diversifies their revenue there and exposure to lots of Australian customers. And we've seen that Coles recently, their CapEx has peaked. And so that's what we want to see is that they're controlling costs. They've implemented this Simplify and Save program to cut about $1 billion off their costs. So that's a very strong thing in a high cost environment that we've seen over the last 12 months. And at the same time, they've increased prices to match inflation, which the ACCC was watching, but there's nothing wrong with the price increases. They're still well under market rates. And so what we see over the next 12 months and the next 2 years in financial years is that compound annual growth rate is likely to grow at the same time that costs are being reduced. So that means profit margins are higher and appreciation there. So Coles Liquor has done well, CapEx has peaked, and we're expecting returns of about $1.52 billion in capital investment programs in Coles over the next 12 months. So again, this company is looking to really encroach on and really cut the gap between Woolworths' leadership position, and Coles has 28% of the market, Woolworths is about 37%. So I see that gap closing over the next 12 months, and Coles is a very good investment opportunity I see over the next 12 months.
Grady, thanks for your time.
Thanks for having me.
That was Grady Wulff, market analyst at Bell Direct. Remember to get your own independent advice before making decisions. This is Fear and Greed Summer Investing Series brought to you by Vanta. Vanta automates compliance for frameworks like ISO 27001, SOC 2, CPS 234 and Essential 8, saving time and money while building trust. Join over 8,000 companies like Atlassian, Dovetail and FireAnt, managing real-time risk. Get $1,000 off at vanta.com/fear and greed. I'm Sean Aylmer. Enjoy your day.